Good morning and welcome to the next session on Money and Banking, Chapter 9, Session 2. In this session, we are going to talk about some of the interesting topics. That's about the different types of ratios and the role of RBI in deciding the monetary policy. So let's have a quick look into what we are going to talk about in today's session. So these are the topics that we are going to look into in terms of money and banking. The first one is the cash reserve ratio. The second one, statutory liquidity ratio. Money multiplier process, very important one. Monetary policy, which governs the economy, so very important topic. Open market operations and repurchase agreement. So these are some of the crucial topics that you are going to learn today in terms of money and banking. So moving forward, what is cash reserve ratio? Quite an interesting thing for us to understand, because cash reserve ratio, the moment the word that comes reserve, so we need to understand that means there is some amount of money which is being kept as backup. So that's where percentage of deposits which a bank must keep as cash reserves for itself. Now, when you look into a bank, it's not just a financial institution that is making money or that is just lending money, but it's an institution that tries to safeguard the cash reserves, the cash asset of the citizens. So any customer who comes to the bank comes with a hope, with a trust, with a belief that his money will remain secured for years to come. So in order to keep up that trust, in order to keep up that belief, in order to keep up that hope, the bank must hold certain cash reserve, so that in times of emergency, if there is any kind of problem, the bank will be able to adjust with the reserve and take care of the money for the customer. Now, this cash reserve ratio, who decides it? The bank, can it do it by itself? Absolutely not. It is decided by the RBI, that is the Central Bank of India. The RBI will advise the bank stating that you need to keep 2.5%, 3%, 5% of the total deposits as the cash reserve ratio. So the RBI will give out the percentage. They will say how much can be kept as a cash reserve ratio, and so that you can continue with your banking business altogether. Now, this is a legal and binding requirement. This word has to be understood very clearly. It's a legal and binding, which means mandatory. You cannot take it lightly. You have to do it as instructed by the RBI. You will not be able to go and tell that, sir, can I have a flexibility there? Absolutely not. You need to follow the rules that are being given by the RBI. Now, to give you a small example in the case of cash reserve ratio, recent stories or the recent news that came about Yes Bank, one of the popular leading banks in India, they had failed to give up the money of the depositors due to some financial crisis. So from that, RBI started instructing Yes Bank that they need to follow stricter norms and regulations for cash reserve ratio. They need to keep a higher provision altogether. Now that became a norm for all the banks across India. So cash reserve ratio is a very important function which the banks need to follow, so that at any given point of time they are able to meet the requirements of the customer and continue with their banking business altogether. Now, moving forward, statutory liquidity ratio. Now, what is the meaning of liquidity? Why is that liquidity becoming an important topic in banking? Now, if you look at banks, every day they will do some or the other cash transaction. They will try to buy in, they will try to sell, they will give advances, loans. All those factors will come into the banking business. But the bank has to keep some form as liquidity, which means easy cash, immediate cash in hand, so that if they want to transact, if they want to lend, if they want to buy, if they want to give it to the customer, somebody comes to the bank today and they say that, sir, I want to withdraw 50,000 rupees. The bank should not be in a position to say no to the customer. It should not say, sir, come tomorrow, I will keep the money ready. No. For the customer, on demand, money should be available. Why? Because for the customer, bank is the custodian of money. So when the customer comes back to the bank and he says that, sir, please give my money back because he has some emergency or need, the bank should be in the form of giving the money immediately. How can I do that? Only if I maintain reserves, only if I maintain liquidity cash with me. So when I have that liquid cash with me, I am able to give it back to the customer, then I will be able to transact smoothly with the customer. So that is why banks are required to keep some form in terms of liquidity. Some cash should be kept in form of liquidity. Preferably around 5% they will always maintain as liquidity. Now that provides safety to the bank, because in case if there is some sort of cash crunch, now in the case of Punjab Maharashtra Bank, which happened in India, another example, at that point of time what happened is that the investors got completely panicked. They were not able to go back and withdraw their own money. The reason is that the bank did not have sufficient cash to disperse the amount back to the customers. Now that is a very, very tragic situation. Why? Because you don't have money to give back your own customers, you are not able to run your own business. Now that puts the bank's image in a bad shape, and it also brings a negative environment to the banking system, to the economy altogether. So that is why you need to keep this liquidity, which will provide safety for the bank itself. So that tomorrow the bank can say at any given point of time, when my customers come to me, when they approach to me in terms of emergency, in terms of need of business, I am always there to support you. So that is why liquidity matters a lot when it comes to the banking system. Second, it gives a cushion to the function at the crunch time. This is what I was trying to tell you. Now, for example, if a bank has got 50,000 customers, and imagine all the 50,000 customers coming back on one fine morning and saying that, sir, please give my money back, the bank should be ready to give the money back. Which means the bank should have enough liquidity, enough cash ratio, so that moment the customer approaches, the bank is ready to transact it back. That is the power of the banking system in economy. So an efficient bank will always think about keeping liquidity, keeping the reserves at the topmost priority, so that when the customers walk in, they don't go back disappointed at any point of time. So statutory liquidity ratio, a very, very important concept for the banks to survive and continue the business smoothly going forward. Money multiplier process. Everybody wants to multiply money. Is that true? The answer is yes. If you put 1 rupee in the bank, after some days or after some months or years, you want to see that the money becomes 2 or 5 or 10. Why is that? Because money is something that gets even more excited or even more interesting when it starts multiplying by itself. What everybody wants in this world is that you put the money and the money starts growing by itself. They want the money to grow like a tree one fine morning. But is it true? Can it happen? The answer is yes. How does it happen is the money multiplier is given by 1 by cash reserve ratio. So suppose your cash reserve ratio is 0.5. So you divide 1 divided by 0.5, you get the money multiplier ratio altogether. So this is given by a new formula or a format called as M1 is equal to currency plus deposits. What is that currency plus deposit? Now M1 is a form of liquid money, what we call it as the liquid cash or an immediate cash. So how is this M1 deposited is that you give the currency factors, the cash in hand, with the deposits, the local deposits that the bank is holding, that will constitute what we call it as M1. M1 itself means a very, very instant liquid form of money that is dispersible by the bank towards the customer. Now for every customer, he will try to understand cash not only from an immediate perspective but also from a short-term perspective. Now when I say immediate versus short-term, that it's a slight different matter altogether in economics. Today when I want money, that's an immediate requirement. If I want that money in a week's time, in a month's time, that becomes a short-term requirement. So what will I think about when I, as a banker, all about is that I will first think about the currency, that is the cash in hand. How much money do I have, including the coins, including the notes that is there with me in the bank? That forms the currency factor altogether. And the number of deposits. When I say the number of deposits, the amount that is there in the deposit, that might tune to several crores of money in a bank. But then that is important for me. Why? Because from a customer standpoint of view, moment he wants immediate cash, moment he wants a short-term borrowing to happen, he will close one among his deposits and withdraw the money out of it. So that is where deposits will form a part of M1. So M1 is that short liquid money that is required for the customer from the currency as well as from the deposit standpoint. So for a bank, the money multiplier ratio and the M1 format is mandatory to understand. They will not be able to survive without this. Now, when you look at banks like SBI, Canara Bank, Indian Overseas Bank, all the government or nationalized banks altogether, they have made it very clear that they will give an equal and a high priority importance to currency and deposits. So they try to see that the higher the number of deposits that are growing up in their bank, the cash reserve also has to be built accordingly. They will not be able to go just like that. Of course, deposits are equal to liabilities. That is one part of the story. But the other part is that higher the deposit, that's also creating a cushion for the bank because the cash reserves are swelling up. So that's very, very important for the bank to see how much currency and how much deposits they are able to mobilize in the long run altogether. Now, moving forward. Monetary policy. In India, we have two types of policy. One is called as the monetary policy. The other one is called as the fiscal policy. Now, when I use the word monetary policy, that means it is the role of money that decides in the economy. When I talk about fiscal policy, that decides about the expenditure. So, who decides the money factor in India? There is only one authorized person, one authorized institution who can do it, and that is RBI. Only the RBI will have the power to expand and give its opinion on the monetary policy, with the Government of India and Ministry of Finance getting involved in it. So the monetary policy, what is the objective of that? Why do we need a monetary policy in the country? We know that we have a currency. We also know the value of currency. With all these factors, why there should be a monetary policy for us? The simple reason is that control of money supply. When you look into an economy like India, which is very vast, which is very diverse, which is highly integrated with many sectors, you need to have a tight flow of money in your system. Because if you start loosening the strings, if you start loosening the strings of your purse and you start spending all the money, automatically what happens here is that the value of the money will start coming down. So for RBI, money supply has to be controlled at each and every instance. They will not leave money just to flow freely in any of the sectors and give people money at their own ease and convenience. RBI decides how much money should flow in the economy and how much money should be held back by the banks. So that is why the control of money supply is highly mandatory for us. Now, during the time of emergency, when we are talking about the current situation, everybody requires money because there is a loss of employment, there is a loss of production, so many economic factors that has led to the downturn of the economy. In this situation, RBI will try to ease in upon the monetary policy so that money flow will be at the maximum. Everybody will try to get some or the other form of cash so that they can run their normal life. So the monetary policy will now try to understand what is the situation of the economy and what does the economy demand in total, so that at any given point of time, money is available with the industry, with the people and with the government at any given point. And lender of the last resort, this is very, very important. Why? Because monetary policy, RBI also comes in the form and says that in case of any backup that is needed, in case there is a challenge for me, in case there is a challenge in the economy, whom can I go and fall back? Definitely to the RBI. Now, RBI is the personality which decides and says that whatever happens to the economy, whatever challenge that you can see in the economy, I am there to back you up. I am there as an institution, as the guardian of economy who can come back and improve the situation at any given point of time. Now, if you look there for a common example, India has come up with the Atmanirbhar plan, which is about 20,000 lakh crores, where we have come up with a huge amount of money altogether. Now, the Atmanirbhar plan is being supported by the RBI. RBI has gone ahead and given an assurance to the government saying that, yes, I will help you to supply that much amount of money so that you will be able to come back and you will be able to revive the economy. So, the role of RBI in monetary policy is of high importance and priority, because of which we are able to survive today, we are able to go forward today, and we are able to see a progress in business and development altogether. So that is the importance of monetary policy. This stands for the control of money supply. This stands for understanding and establishing the value of money all across the sectors of the economy. Now, moving forward. Open market operations. What do you mean by the word open market operation? Is that anybody can enter, anybody can trade in? Now, let's try to understand the open market. The government will issue bonds of certain face value with an interest rate on it. Now, this is done by the government in the open market. So that is where we need to understand the process. Government in the open market. Now, why does government issue bonds? Government has the money, so why should they issue a bond? In case of any projects, in case of any infrastructural needs, in case of any financial needs, government will go back to the public and they will issue bonds at a particular value. Let's say they are issuing a bond at 8%, saying that a railway infrastructure bond or India development bond, India sovereign bond. Like this, if they are releasing some bond, they are buying and selling that bond in the open market. They are issuing it to the public saying that please buy this bond at a particular rate, and after some period of time, that is a fixed period of time, I will buy back the bond from you at a fixed rate of interest, which is very much secured and a promised delivery altogether. So government will do this open market operations in order to transact with the public and take in some money for the development of the country. So RBI takes the complete control. RBI decides with the government saying that in case of any money transaction that is borrowed from the public, now somebody needs to authorize, somebody needs to give the hope, the belief, the assurance factor that nothing will happen to your money at the time that has been promised, at the rate it has been promised, I will give back the money. Who gives you the assurance? RBI gives the assurance saying that whatever financial transactions that is taken place from the government side in the form of bonds, I assure you that I will repay back the money at the given percentage time. So that is where RBI stands as an assurance, as a guaranteed personality who will take care of paying the money back on time. Similarly, increase in reserve. What is that increase in reserve for the government? Now, for example, when government takes money from the public, automatically the cash reserves of the government starts going up. So by selling those bonds, government gets money. So that money goes into the treasury of the government and government can use that money for any development process. So bonds are the physical methods, are the primary methods through which the government can raise money for any project in this world. So that is why we always say that the issue of bonds, the issue of open market operations altogether is the primary push for cash reserves to happen in our economy. And this is very, very important because we cannot take this open market operations lightly. This will actually make a very great sense of operation, which will make a very great sense to the economy altogether in making a progress, in making a development altogether. Moving forward. Purchase and agreement. So now when we talk about the repurchase agreement altogether, now repurchase is something when the RBI itself agrees and says that I will buy back the bonds from you at a particular time, at a particular rate. So that's where we say with an agreement, security with an agreement, where the RBI promises to the public, whatever might be the situation, on this date, on this interest rate, I will take back the bond from you. So this makes the public get a secure feeling, saying that whatever happens, RBI is there to back me up, and they will buy back the bond with a repurchasement agreement stating that your money is secured. Now this is the biggest push in an economy. Why? Because when you look at a country like India, hundreds and crores of people who are there, they are always dependent on some form of income, some form of backup. So they always need the push from the government saying that whatever happens, we are there to back you up. We are there to support you. We are there with you so that your development is not hindered. So that is why you always look at this factor called as the repo, which is what we try to talk about, the repurchase agreement. The RBI agrees to whatever conditions, to whatever situation, on the fixed date, on the fixed time, I will buy back from you. So that will make the public get a belief, get a trust on the government, and they will invest in the government projects altogether. Now, moving forward. With this, we come to the conclusion of today's session. Thank you for joining me on this wonderful session. I hope and believe that the session was interesting and informative for you. In the next session, we shall be seeing about what are the different types of motives, what are the different functions altogether in money and banking. Until then, goodbye and good luck. Stay tuned, stay blessed, and stay enlightened forever. Thank you once again for joining me today.